Hello, welcome everyone to the ProfitRoom.com, our educational series. This subject is a guide to short selling. Now, many individuals are familiar with buying a stock, buying low and sell high. That's a term commonly used. But you can also short a stock, which is very common nowadays, or short a commodity like a futures contract, or short a forex pair. And we're going to go over that. Sometimes it could be a little confusing, so we want to explain that, especially with our picks that we have. Depending on the market trend, it may be a bearish trend, so we may short, or we may see a nice technical setup in order to short. So a guide to short selling, we're going to find out what is short selling, how does short selling work, and we're going to give an example of short selling. Nice video, very simple for you to understand. So first of all, what is short selling? Short selling is a trading strategy many individuals use. So you believe either a stock, a commodity, forex pair is either overpriced, or it can be hit in the form of what we call resistance, and we'll show you that on the chart. So your anticipation is for the stock, commodity, or forex pair to go lower. So in order for it to go lower, you need the stock in order to trade short. So when you do that, you borrow shares from a broker. Now you'll see this in the illustration. I'm just giving you the definition now. You borrow from the broker in anticipation that the stock is going to go lower. Once it goes lower in your favor, you buy it back, which they call covering, at a lower price. Then you give the remaining shares back to the broker, and you capitalize in a profit in between. So once again, the short seller closes out the short position by purchasing the equivalent securities on the open market. So we'll show you that as well. So when you purchase, you're buying back after you short, you're giving back to the lender. Now you're probably like, I definitely don't understand this, but let's go over this cycle. You'll definitely pick up the cycle. So here we go again. We already got the definition. So your broker has shares of stocks, right? They keep shares of stocks because people are buying stocks and selling stocks every single day. You as a trader, you need to borrow those stocks in order to short it. And we're saying short, that means we want to go low. We definitely want to go low. So this is the process. A short seller borrows a stock from the broker. In order to short, you need a margin account. We'll go over that in another video as well. But just going to go over the basics here. You borrow the shares from the stockbroker, right? That's step one. Short seller immediately sells the stocks on the market. Now you don't have to do this. This is automatically done when you hit the short button on your platform or the sell button on your platform. It's coming from the broker to you, and you're anticipating the stock or commodity to go lower. Step number three, the short seller buys back the stock from the market. That means you decide to cover. That's called covering. So you buy back. Step number four, the short seller returns the borrowed stock back to the broker. This all happens simultaneously, step one and number two. This is what you have control over when you cover, when you decide the price gets to where you want, and number four automatically goes back to the broker. And let's have an illustrative picture of that. So once again, you may have to watch this video a couple of times, but you'll understand it. You have the broker goes to the short seller, who's you. Once you short or sell, it goes to the open market. These two are simultaneously once you hit the short button or sell, depending on your platform. Step number 3, it goes to the short seller when you decide to cover. Then step number 4, it goes to the broker. So this is selling the stock and this is buying it back. So not to confuse you, we'll look on the flip side. So imagine if you was going long on the stock. This would be you buying the stock and this would be you selling it back. But we're not doing that. We're doing vice versa. This is you selling the stock because you're borrowing it from the broker, and this is you buying it back. It's just flipped around. Let's look at an illustration. So you see a chart like this is moving up and down. This right here shows a downtrend. This shows an uptrend. Now many individuals are used to buying stocks here. Say you buy at $42, right? Let's give an example. You buy at $42. So you bought 100 shares. It goes up, up, up. You sell at 58. You bought 100 shares. That's 16 points. That's $1,600. Yes, easy math. But what are we doing as short sellers? Remember, brokers have these shares of stocks. That's their job. They hold stocks. That's why they call a broker. And you as a trader notice that this stock may continue this pattern and go down lower. So what do we do next? We short seller borrows from the broker. We immediately sell the stock on the open market. So we short here at 58. We borrow 100 shares at $58 from our broker. And we anticipate it going down. Once the stock comes down, we buy it back at $42. So you understand it? Remember, we buy here and sell here. We're doing the opposite for the same profits. We sell here and buy here. This is called covering. We keep what's in between. We keep what's in between. 16 points, if we shorted 100 shares, would be $1,600. That's our profit. Once we buy back, those borrowed shares goes back to the broker. So let's say do this one more time. We see this here. We short 100 shares. Now, what happens? It goes in our favor. It comes all the way back down. We buy back. Once we buy back, we profit what we made in between. Once it goes back to the broker, we made the profits. Now, just how if you bought a stock and the stock went down and you sold here, what happens? You lose your money because you were wrong. The same thing is when you short. If you short and the stock goes up, you lose your money because you are buying it back at a higher price. So you buy shares here $42. It drops at 41. You sell real quick. You lost 1 point. Similar scenario. You short here or sell at $58, anticipating it goes lower, but it goes higher to 59. You're buying back up here. You lost. Let's look at some scenarios of where you would short at. Look at these charts here. As you see here, there was some shorting going on, right? You short down here in the red. People short the trends. This is a longer term trend. Comes all the way down. then you cover. Then what happens here? People look at that this may be support, then they buy it back up, right? Then you see here, we see some selling going on. Then we see some buying going back up. Then we see some short selling going on. So either way you look at it, on a longer time frame, some individuals short for a long time, then they cover. Just like you can buy for a long time, then sell. When we provide our swing trade analysis, our swing trades sometimes are mostly on a week or 2 or 3 week basis. So you could short here between $20 and cover here between $12.50. That's the whole process of shorting. So I hope this video was uplifting, so you could basically get an idea of how it works. It's just only thing that you have to look at is basically like flipping the chart. You know, sometimes the mindset could be a little tricky on how it works, but just know that you're capitalizing on the move in between, just the same way you're capitalizing on the move when you're going long. So no matter how many shares you bought, if you would have bought 50, 100, 200, or 1,000, your risk management is in between what you plan on getting before you buy it back. So when we offer our shorts, we give our risk to reward ratio. We give our price targets. And it's very simple. Once you do it a couple of times, you'll be able to understand. It's just a little mind glitch because we're so used to buying in the market. Some individuals don't want to short, but we understand there's different market cycles of support and resistance. And the more you understand that and you grasp the concept of shorting, you'll be able to make money in any type of market, bullish, bearish, or trending market. So for example, like this X, there were people shorting this, making a lot of money. There's nothing unethical about this. This is how the market works. Then what happens when it went to historic support? There was a lot of people buying it back up. So once again, if you got any questions, you can always email us, and we'd gladly be able to help you and assist you even more. Watch this video a couple of times, and we definitely know you'll benefit from short selling. Alright, as always, enjoy and trade safe.